There is an underlying sentiment right now that perhaps a higher level of concern should be warranted. And that underlying sentiment is bolstered by the fact that the U.S. is on the brink of experiencing a simultaneous onslaught of 4 economic shocks. Let's go ahead and dive into those right now. Number one is the United Auto Workers Strike has potential to significantly disrupt the automotive industry. Commencing on September 15th, the United Auto Workers Union initiated a targeted but historic strike against Detroit's prominent automakers. In just 1 week, the strike has inflicted an economic toll exceeding $1.6 billion on the U.S. economy, as reported by a study conducted by the Anderson Group. While the strike initially involved fewer than 15,000 union members, its gradual expansion poses a substantial risk to the Federal Reserve's ongoing efforts to combat inflation. And the core demand of the UAW centers on significant wage increases for its members. This demand carries broader implications, potentially influencing workers nationwide to seek similar wage hikes elsewhere. Such a ripple effect throughout the country could actually exacerbate inflationary pressures, compelling the Federal Reserve to implement more aggressive interest rate adjustments moving forward. The rising wages resulting from union-driven efforts have the potential to simultaneously impede economic growth and rekindle inflationary trends. Moreover, the strike's effects are not limited to a national scale, but also manifest locally too. As striking workers receive only really a fraction of their regular pay during the strike, it's anticipated that consumer spending within their individual communities and pockets is going to decline throughout the strike's duration. Although the Michigan economy may experience setbacks, the prospect of workers achieving the higher wages that they seek offers potential compensation, as demonstrated in the aftermath of the previous UAW strike back in 2019. Now, furthermore, the prolonged duration of the strike will yield progressively wider repercussions across the automotive ecosystem, impacting automakers, workers, suppliers, dealers, and of course consumers alike. And there's already anecdotal evidence here that suggests that both new and used vehicle prices are really on the rise, driven by anticipation of a sharp drop in inventories due to the strike. However, it is worth noting here that the automotive landscape has evolved, with the big 3 automakers no longer wielding the same national dominance that they once did. If the strike persists for 6 weeks, it may marginally decrease fourth quarter gross domestic product growth, albeit by only approximately 0.2%. The second economic shock that we're faced with is the resumption of federal student loan payments. And this is something that we've talked about before, and we do have an individual video about it, but it does need mentioning as it affects nearly 44 million borrowers, and it has been a topic of major concern among economists and analysts due to its potential impact on the broad economy. After 3.5 years of a hiatus, these borrowers are now going to soon begin making average monthly payments of $393 to their loan servicers, inevitably resulting in reduced spending in other areas for some households. Estimates regarding the economic consequences do vary, but according to a July report on Oxford Economics, consumer spending in the U.S. could decrease by as much as $9 billion a month, which could shave 0.1% off of the GDP growth in 2023 and 0.3% in 2024. And this situation has implications for retail spending, as well as the resumption of payments being a key pain point for consumers as they adjust to their new budgets through the end of this year. It's not only consumer spending that will be affected here. Borrowers also anticipate reduced savings and retirement contributions as a result of the student loan payments resuming this month. According to Morning Consultant, over 70% of households earning at least $100,000 expect to miss at least one payment when they resume payments. Additionally, other federal government programs, including the Biden administration's more generous income-driven repayment plan and a 12-month grace period, that might actually help mitigate some of the economic impacts of the return of student loan payments, not to mention the multi-billion-dollar loan forgiveness that just was announced. Now, Dean Baker, founder and senior economist at the Center for Economic and Policy Research suggests that there may not be significant visible economic effects, stating there's not going to be any great consequence if someone doesn't immediately start paying. I don't think it will be catastrophic. Well, I guess we can wait and see, right? Now, the third economic shock that we're faced with is the price of oil. Oil is on a trajectory towards surpassing the $100 per barrel mark. A look back at U.S. history shows that oil price surges have consistently acted as a catalyst for economic downturns. Elevated oil prices result in heightened expenses for a wide spectrum of different companies, and they place burdens on consumers, on budgets, and potentially instating a surge in inflation and a reduction in consumer spending. I know it's having a huge effect on our sewer business right now with all of our equipment and vehicles. So presently, the U.S. finds itself confronting a looming economic quandary as oil prices have surged since June, primarily due to production cutbacks from major crude producers, including OPEC+, comprising Russia and Saudi Arabia. The international benchmark, Brent crude, has surged by 28% from its June 11th low of $74 per barrel to well above $95 per barrel. Furthermore, commodities experts at numerous investment banks such as Goldman Sachs and Wells Fargo, they contend that the ascent in oil prices heralds the dawn of a commodity supercycle. And lastly, the fourth economic shock that we're facing is in the housing market, specifically in the resurgence of mortgage rates approaching now 8%, raising concerns about a renewed housing market slowdown. The Federal Reserve's efforts to combat inflation by gradually increasing interest rates has introduced a series of complexities. It's affecting investors, businesses, as well as consumers. But among the people that are most affected are prospective homebuyers who now confront the highest interest rates in over 2 decades, with the 30-year rate nearing 7.5%, a considerable departure from the sub-3% rates that we all enjoyed and observed during the early stages of the pandemic. And these elevated interest rates compound the challenges of housing affordability that really have emerged in recent years amid soaring home prices as well. According to the real estate analytics firm Black Knight, the average monthly principal and interest payment for borrowers rose to a record $2,306 back in July, marking a 60% increase over 2 years. In July, nearly 25% of homebuyers faced monthly payments of at least $3,000. Additionally, over 50% of homebuyers are now paying at least $2,000 a month. This is going to leave a lot of people house poor. We have to face that. And despite the economy maintaining relative stability throughout the year, further rate hikes by the Federal Reserve, they could introduce complications, potentially leading to a slowdown in home sales. Such a development would have far-reaching consequences across the broader economy, as elevated rates can precipitate a reduction in consumer spending and exert significant pressure on the housing market, consequently hampering economic growth, of course. Now, this economic deceleration isn't confined to consumers alone. Businesses also tend to curtail their spending and investment activities when interest rates are elevated. In September, the Federal Reserve chose to maintain interest rates at their existing levels, signaling its confidence in the overall state of the economy. However, an additional rate hike is anticipated still later this year. So we're going to see how that all ends up shaking out and affecting the housing market moving forward. But I'm curious, do you guys think that these 4 potential shocks to the economy will lead or converge into a recession? I'd be interested to hear what you guys think of the state of things. Are you worried, or do you think we're in decent shape right now? Go ahead and leave your thoughts in the comments section below. If you found this information valuable, please leave a thumbs up. It helps us a lot. Make sure you're subscribed to the channel if you're not already. We do upload several videos a week, so there's a lot of really great information in here to help you build your self-wealth, maintain knowledge on what's happening economically, and of course, beat the banks at their own game to help you go further, faster financially. So until we see you on the next video, make it a great day today and keep on cash flowing.